All right. Matt, the mortgage guy. In today's video, I'm going to go over this latest update, this latest bulletin from Fannie Mae. This came out earlier this week, August 11th, 2021. But as you'll see up here, these changes won't be implemented until mid-September, but there's a few in here. I'm not going to go over every single one of them. There's a few in here that I think will impact my clients, which are more relevant. And so I'll go over those in detail. Before I jump into it, if you like straightforward mortgage content, little talk about the housing market, what I see and hear and think about the market on a daily basis, because I'm talking to hundreds of clients, I'm talking to hundreds of real estate agents. I'm going to give you my take, my thoughts, my feelings. With stuff like this that's related to mortgage, I'm not only going to tell you what the guideline says, but how I think lenders are going to implement it, how it might impact you as a borrower, and all that good stuff. So if that's the stuff you're looking for, please consider subscribing to the channel. 3 times a week on Tuesday, Thursday, and Saturday, I'm putting out mortgage market-related content. Every Monday, 6 p.m. Pacific Standard Time, I'm doing a Q&A where I answer any questions you can think to throw at me. I've thoroughly enjoyed that. So if you haven't joined a YouTube live on Monday at 6 p.m. Pacific Standard Time, please consider doing that. They're a lot of fun. So without further ado, let's jump into it. This is going to be implemented in mid-September. Fannie Mae, their automated system is DU, Desktop Underwriter. So for anybody who doesn't understand, conventional loans are going to be run through two different automated systems, Fannie Mae's DU or Freddie Mac's LPA, Loan Product Advisor. And all the data, credit score, credit history, down payment, amount of funds you have available for the transaction, and all that gets basically submitted to an automated system. That automated system spits out approve eligible or approve ineligible. So when changes are made to how the automated system is going to read the information or what they're going to take into consideration with their automation, it's going to impact you as a borrower, right? So this stuff is important. And I'm not going to go over each one of these, just a handful of them, the most impactful ones. First one, which is going to help a lot of borrowers that might have a thinner credit history, might have less, in this risk assessment model that the Desktop Underwriter is using, they might need a little help, I guess is what I'm trying to say. They're going to, when this one gets implemented, the weekend of September 18th, going to be able to use their positive rent payment history to this DU risk assessment. So if there's a 12-month VOA, which is, verification of asset rent history, we're going to be able to use that as a factor in whether they get approved or not, right? And so let me just read this. Beginning, the borrower is currently paying rent of $300 or more, and a 12-month verification of asset was obtained. DU will attempt to identify recurring rent payment transactions within the VOA report for use in the credit risk assessment. So long story short, going to be able to use your rental history, your positive rental history, to help you qualify for a home loan. It might be that you're putting 3% down, you got a 682 credit score, you're right there on DTI requirements, and it's something that the system might not have liked in the past if we throw in, hey, this person's paid their rent on time for 12 plus months. That might help get that approved eligible. That's basically what this is saying, right? This just goes into detail of what the system is looking for to identify rent payments. We must put the monthly rent in the DU loan application. We must order that 12-month VOA, enter the corresponding reference ID. This is a bunch of lender instruction. Confirm that their account holder, yada, yada. And then it's going to give us in those automated findings a message that says rent payment history is used or why it's not used. Okay, cool. That's enough about that one. The next one I want to go over is this credit score eligibility in DU, which I think is really, really interesting. One thing I'll say before I even talk about it is this is what the scoring model Desktop Underwriter is looking at when determining approve eligible, right? This doesn't mean that lenders need to necessarily follow this guidance, but lenders are going to use the same type of reasoning, the same type of modeling. And you'll see what I mean as I dig into this. In general, you can't do a conventional loan for under a 620 credit score. And if you didn't know, I'll tell you now, when you use more than one borrower on a loan, we're taking the middle score, like look at these two borrowers down here, 590, 619, and 648. 619 is the middle score for that borrower. Borrower 2, 661, 693, and 693. 693 is the middle of the three. It doesn't matter that it's there in the middle. It's low, high, and middle, right? We have to use the lower of the two. That's how we've always done it, 619. For qualifying, for the terms of the loan, for the pricing, for everything, right? It's the lower of the two. If you've got a 600 middle score and an 800 middle score, it doesn't matter that person's got 800. It doesn't pull the lower one up. The lower one is the one that is used for qualifying. That's been the case, right? So what this is saying is that starting with this update in mid-September, DU is now going to look at this file and take the average of those two scores, which is 656. This does a couple things. One, it gets you above that 620 minimum so that you can actually do a conventional loan and get an approved eligible. And two, in the case where the second borrower is a lot higher, I think it's going to be creating a lot more approved eligibles where in the past, this is me assuming as a lender, you've got 622 on one side and 740 on borrower 2. Like this 622 is just a high risk from the automated systems like viewpoint, right? It's going to be hard to get that thing approved eligible. So here is my, warning. Just because DU is going to be able to get an approved eligible because they're using the average of the scores, don't assume that lenders are going to allow a borrower, let's say one of the borrowers is a 590 middle and the other one's an 800, and the middle score of those two, what falls in the middle, 695. Don't assume that lenders are just going to say, oh, okay, cool. Yeah. 695. We can use 695 for pricing. We can say they're approved eligible. It's all good. One thing this thing did say in the small print is that this average median credit score will only be used in the eligibility assessment. The credit score will continue to be used for pricing any applicable mortgage insurance requirements and need to be provided at loan delivery. So basically, if we have this 656 mid score in this example being used, it doesn't mean that the lender is going to give you pricing based on 656. The lender can give you pricing based on 619. My question as well, lenders that don't go below 620 won't have pricing for a 619 score, right? So what do you do then? There's still some things that need to be answered from the lender's perspective. So it's going to be interesting to see what the method will not result in a credit score lower. Oh yeah. Okay, so that's that. Last thing I wanted to go over was this DU eligibility assessment update, which I think is pretty cool. Quick recap for anybody. DU eligibility means plug it into the system. The system tells us this person's approved eligible, approved ineligible. What we've seen as lenders in the past, which can be frustrating, is approved ineligible, and it's not really clear why. Is it the low credit score? Is it that we're only putting 3% down? Is it that we've got very little in reserves? Could it possibly be some of these derogatory things on the credit score? We might not necessarily know and be able to pinpoint. Running enough loans through the system, I can tell you that working with my processor, sometimes add reserves. Okay, that's the problem. Okay, put 5% down. Okay, that's the problem. You can kind of figure it out, right? You can tinker with it and change some of the variables to see why a file may or may not be approved. But this is cool because I think what this is saying, if I read it correctly and I understand it correctly, is that if you receive an ineligible recommendation, you submit your loan into Desktop Underwriter and the findings come back approved ineligible. You're like, man, It's not approving at a 37% front end and a 43% back end. That's DTI that I'm talking about there. Rather than like having no idea, what this is saying, when there's risk factors that are present and it doesn't meet, this they say, does not meet our affordable housing mission. That's what they say, whether they want the loan or not, whether it's got too much risk for them or whether they're allowed to take it. Like, is it part of our mission? Nice wording there. They'll provide additional detail regarding the factors that contributed to the ineligible recommendation. So what this is saying to me is that, hey, listen, in the cases where we're providing an approved ineligible finding to you as the lender trying to get somebody approved, we'll at least give you some clarity and additional detail as to what factors contributed to that, so that me as a lender can say, listen, you got to put 5% down versus 3%. The system's telling me that. Or you've got to raise your credit score. It really doesn't like your credit score. We got to wait for this derogatory thing to fall off your credit. Whatever it is, we're going to have some clarity on why it didn't get approved. So I don't want this video to go too long. Those are 3 of the, whatever it was, 7 or 8 different things that are coming out with this latest update from DU in mid-September. If you have any questions, comments, feel free, leave it below. Let me know what you think of these changes. Let me know if you have any questions on it. If you're looking for mortgage advice in California, I'm more than happy to help. Shoot an email to me and my team, matt@mattthemortgageguy.com. If you're outside of California, happy to connect you with a great broker. All you got to do is go to greatmortgagebroker.com, fill out 6 questions. Ding, 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 ding. You'll be connected with a great mortgage broker. Again, that's greatmortgagebroker.com. Thanks for watching. Appreciate you.